All right. Today is Thursday, September 29th, and this is a recap for the stock market activities today. And folks, I got a good one for you tonight. But before we start, thank you for everybody who joined as a member. Thank you for everybody who's using the thanks button. Thank you for everybody who's pressing the like button, subscribing, leaving a comment. And if you're not sure what kind of comment you should leave, just type whatever you ate for breakfast this morning. I mean, think about this as your breakfast diary. Now, I want to do a short market commentary because I want to get this to you as soon as possible. We have an important day tomorrow. But rest assured, over the weekend, we will do a macro deep dive. But tonight, let's recap how the events unfolded today. We have an update from yesterday's conversation about Britain and the insanity that is going on over there. And of course, the bloodbath continues. Overnight, the London Exchange lost over 2% of its value. And right away, U.S. market futures responded by diving down. And now we're hearing from the betting markets, the odds show that Liz Truss might step down by the end of the year. She's been in the job, 2 weeks? And it's already a mess, and she might even resign by the end of the year. And after that, right away, we got the news from Germany, and the inflation rate in Germany shot up higher to 10.9%. This is the first time the inflation rate in Germany reaches double digits since World War II. And in response, U.S. market futures took another dive down. And adding to the misery, right before the U.S. market start, we got the initial jobless claims for the week, and they came out at the lowest level since April. Now, this is supposed to be good news economically. We're not seeing a significant rise in unemployment. If anything, we're seeing unemployment moving down. But this is bad news for the equities market, and the reason is it allows Jerome Powell and the Fed to be even more aggressive, to front load more interest rate hikes to tackle inflation down while the unemployment rate remains steady. And of course, the geniuses who bought the dip yesterday because the Bank of England decided to wave the white flag, and they assumed the Fed will do the same, well, they poured over $7 billion on the riskiest assets yesterday. And today they got schooled, they got smacked in the face right away. A massive $7 billion worth of a warm pie right in the face. Why is this happening? You see, Bloomberg published this today. It reads, Jerome Powell needs investors to lose money. You got Papa Jerome with the whip, and every time you geniuses buy the dip, Jerome Powell whoops your little booty over and over and over again. Why is he doing this? Well, he told us. If you watch the Dark Powell video that I made, Jay Powell told us in the last FOMC conference that what he's looking at is financial conditions to tighten and to stay tight for as long as it takes for inflation to go down. Well, when the stock market moves higher, financial conditions loosen, and therefore no rally allowed without any merit. What are you talking about, Maverick? Hold on. We'll talk about this in a second. What a merit means. But he's not going to allow any rally from this point on. If anything, he wants the stock market to go down and then stabilize in range because he wants financial conditions to rise higher and then stay there, stay tight for as long as it's going to take inflation down. Because if he tighten financial conditions and people start to freak out to say, oh, the Fed is over tightening, and he start to loosen again, financial conditions are going to loosen and inflation will move higher as a result. He cannot afford to do that. He has to kill the inflation monster, and killing the inflation monster requires tightening financial conditions for a while. What is while means? Well, it means what the Fed said. The Fed said they will get interest rates to a restrictive level and then keep it there. Now, we can argue what restrictive is. The Fed says 4.5%. I said it's going to be north of 5%, but 5 is a start. And this means that the Fed is not done increasing interest rates. And so long as they continue to increase interest rates, the market will not be able to find a solid bottom. Now, as an investor, as a trader, you're listening to me right now, what does that mean? It means once the Fed gets to that number, let's say it's 5%. Let's assume that the Fed is satisfied with 5% as restrictive, quote unquote. From this point on, the Fed will hold at 5%. That is the moment when the market is going to try to find the bottom and then consolidate from that point on in a range as the Fed keeps interest rates in that particular restrictive rate, whatever that is. Let's say it is 5. So we still have a little more to go. And I'd rather use this indicator to buy the dip rather than using these sentiment indicators, which a lot of you are doing, and a lot of money managers are doing the same. They look at these bearish momentum indicators, bearish sentiment indicators, oversold, overbought indicators, and they say, okay, this is the time to buy the dip because the sentiment is extremely bearish. Now, the problem with this logic is Well, the bearish sentiment can get even more extreme, and therefore I'm using other indicators, among them what the Fed is actually saying. We're not going to see the bottom until we see the top in interest rates. And for now, we don't have a clear vision where that interest rate's going to be. But there are other indicators that could tell us where that rate is going to be. One of those indicators are coming out tomorrow. But before we talk about that, let's talk about the technical indicators. These are the last three remaining defense lines for the bulls. Apple 150, the June lows, and the 200 days moving average. We know that Apple 150 is gone now. Poof. We're waiting on the June lows. We got another bounce today, and we're waiting for the 200 days moving average. The likelihood is when one of them breaks, the rest of them will follow. And if that happens, then we have another flush down coming. Therefore, if you're debating when to buy the dip, you got to watch these three levels. One of them already lost, one of them already broken. But we have to give the bulls the benefit of the doubt until all three are gone. And by knowing that, you can save yourself a lot of money by not buying the dip right now, only to find yourself catching a falling knife. A buy the dip opportunity right now will not happen until all three lines of defense are kept for the bulls. And on top of that, you need a fundamental catalyst that advances the argument of peak interest rate hikes, not a pivot. You see, the bulls need to grow up and become more mature. Forget about peak inflation. That bullshit is not going to work because inflation is sticky, so the peak really doesn't matter. And on top of that, the Fed pivot argument is stupid because the Fed is not going to pivot. It's only going to pivot if the economy is collapsing. You think the market is going to do okay when the economy is collapsing? What you should be looking for is peak interest rate hikes. When will the Fed reach the so-called restrictive rate and then hold from that point on? And knowing that rate and knowing that timing will give us a better buy the dip opportunity than what we're getting right now. These phony rallies that last for a day or two, fix the oversold conditions technically, and then fade away. Now we have an important piece of data coming out tomorrow, which could give us more clarity on where the peak interest rate hike is. What is the restrictive rate that the Fed is looking for? And this data is PCE inflation. You see, the Fed likes PCE over CPI, and the reason is PCE plays down the true nature of inflation a lot better than the CPI. So it is not a surprise that the Fed likes the PCE over the CPI because it gets them closer to the 2% target. Even though we all know all of this data is cooked and the true nature of inflation right now here in real life stands at double digits territory. But you see, the CPI came out hot in the last reading, and the reason is rents, shelter. You don't need a massive increase month over month in shelter cost for the CPI to shoot up higher. And the reason is housing is about 42% of the formula of the CPI. On the other hand, in the PCE, the share of housing is down to 22.6%. Significant, but not as significant as in the CPI. Yet we have medical care costs, which the PCE gives more weighting to, and we know that these costs are moving higher. Likewise, it gives other goods and services more weighting. It gives a similar weighting for food and beverages, and it gives less weighting for transportation than the CPI. We know transportation costs are moving down, so while the bulls can celebrate that housing has a smaller slice of the PCE compared to the CPI, they might get caught by medical care costs or by the fact that the drop in transportation costs will not show up as much as it did in the CPI because it has a smaller rating in the PCE. So who knows what the headline rating is going to be, but what we're looking for here is the month-over-month increase in PCE inflation. Last month, the PCE headline was negative 0.1%, and that was celebrated as a drop in inflation. But after the conference by the FOMC, we know what Jerome Powell is looking at. He's looking at core PCE, which is PCE excluding food and energy. And in the last reading, this was up 0.1%. So a positive/bullish reading for the market would be if core PCE goes down to 0 month over month, or better yet, even negative. However, if core PCE month over month moves higher, let's say 0.2, 0.3, that would be a major problem for the market, and the reason is it will push the Fed to become even more aggressive. It might give the Fed the go-ahead to do another 75, if not 100 basis points increase in the next meeting. So this is what I'm watching for. But we have another market mover coming, and this stems from China telling their banks to prepare for a massive dollar dump and yuan buying spree. So the yuan is crashing, the worst year since 1994. Many other currencies are crashing, and the reason is the dollar continues to move higher. Well, here we have the CCP saying we'll put an end to that. We're going to dump a massive amount of dollars. This should push the Dixie, see the dollar index down, and as a result, it could be a catalyst for the stock market, but most importantly, commodities, to move higher as the Chinese keyword attempt, to shore up the yen. And the last thing to watch out for in tomorrow's session is we have rebalancing. About $26 billion will be sold off in U.S. equities by these pension funds rebalancing, but they will buy a decent amount, at least $16 billion, in buying equities in overseas markets, perhaps emerging markets, who knows. But they're buying overseas and they're dumping domestically. And this should be a major market mover, and it might even push the dollar further down. My last thought here is the bears made significant advances as of late. We are now at a pivotal point. Either we're going to crack below the June lows, we're going to lose the 200 weeks moving average in the S&P 500, and that will open the sinkhole in another massive leg down, or we could have a surprise from any of these events that could act as a rescue for the bulls in another attempt at a rebound. I don't see China pushing the dollar down as the immediate reason for that, and we're watching at critical levels right now. We're watching the June bottom and the S&P 500. Is it going to hold? Is it not going to hold? So who knows when China is going to buy more yuan and dump the dollar. So now we're looking at two things. We're looking at the pension rebalancing. That is negative for the bulls because the assumption, at least for now, they're going to dump a lot of stocks. The only savior could be the core PCE. If it comes out at zero month over month, or better yet negative, we might hear the revival of, oh, the Fed is going to back off at some point. Oh, we can see peak interest rate hikes coming perhaps in 2023. And this is a reason to start a rally again. The problem is, will the Fed, assuming that happens to begin with, will the Fed look at the data and agree with the market that they also see an end to interest rate hikes based on core PCE tomorrow? Because if they don't agree with the market, guess what will happen? Jerome Powell is going to whack your little head again. Now, what if the core PCE comes out hotter than expectations? What if it comes out positive by 0.2? Then we're talking about the June lows gone, along with the 200 weeks moving average also gone, and a massive leg to the downside will take place. And therefore, I say tomorrow's session will be extremely important. So let's not prolong this conversation and get you out here early, and I'll do that by moving on and covering the stock market information for you, starting with the closing of the indices today. And here we go. The Dow Industrial Average was down by 458.13 points, or a decline of 1.54%. The Nasdaq leading the pack to the downside, losing 314.13 points, or a decline of 2.84%. The S&P 500 in the red, down by 78.57 points, or a decline of 2.11%. The sector's performances, all in the red, shame on all of them. We're not giving any medals here today, and the laggards were led by utilities, cyclicals, and REITs. The advance to decline ratios, NYSE 13% advancing versus 86% declining. The Nasdaq 20% advancing versus 78% declining. What a difference a day makes. Yesterday, we were talking about 90% of the breadth in the NYSE advancing. Meanwhile, today we're talking about 86% of the breadth in the NYSE declining. Unbelievable. The volatility is amazing here. What about futures, commodities? The dollar was down, not by much as it was yesterday, but it was down. It lost about half a percentage point. The sterling is still riding higher on the flip-flop by the BOE. So what we're seeing right now is the dollar going down, and this is supporting certain commodities to move higher, specifically the most sensitive ones, such as copper. Metals. Copper moved higher today by about 2%, but while the dollar is a tailwind for commodities to move higher, and when we say the dollar, we mean the dollar moving down. We also have massive headwinds battling against that. And these massive headwinds are Fed tightening, central banks tightening, on top of recession fears. Any news of a slowdown in China, slowdown in Europe, and you have this battle between the tailwinds and the headwinds in commodities. And therefore today, energy commodities were down. They lost some of the ground they gained yesterday, not by much though. Both the WTI and Brent were down a little over half a percentage point. Meanwhile, the RBOB gasoline continues to go down, and it lost over 2% today, while heating oil down about 1.5%, natural gas down about 1%, and then we have certain rebounds in softs coming from cocoa. OJ futures went higher, of course, in the heels of the hurricane in Florida, a disruption to supplies. You know the story. Yet we have declines, big ones, led by cotton, down over 3.5%, followed by lumber, down over 2.5%, and then coffee futures down about 1.25%. When it comes to meats, muted action for lean hogs, but we have bounces for a little over 1% for both live and feeder cattle futures. We talked about metals muted across the board for precious metals, gold and silver, yet we have, as we talked about, copper moving higher, and palladium also gained ground of about 2%. On the other hand, platinum was down about 1% or so. Grains, mixed picture, muted action for soybeans, corn, rough rice. Yet we have losses here led by soybean meal and wheat futures. On the other hand, we have gains led by soybean oil futures, closing at about 2.75%. And then we have gains for canola of a little over 1.5% and oats at almost 1.5%. All in all, a mixed picture in commodities, but if the dollar continues to move down, then we know we have a sustainable floor/tailwind for commodities. But will the headwinds ease? Are we going to see more data suggesting that the recession risk is moving down? Are we going to get more data suggesting that central banks, in this case the Fed, will ease a little bit? The problem is none of these two are foreseeable, at least in the near future, and therefore the headwinds are also intact, and hence the battle. Moving on to the big casino, the options market. What's going on here? The volume moved higher for both Tesla and Apple, yet the options volume remains subdued for the rest of the market. And isn't it interesting that the last two blocks to fall, Apple and Tesla, are seeing increased volatility these days? Both closed the day with about 2.4 million contracts traded for each, and the share of calls in Tesla was 51.5%. On the other hand, puts outweighed calls for Apple, yet again with about 51% of the volume. Amazon at number 3 at around 700,000 contracts traded today. They're buying more puts, and in this case about 52% of the volume was for trading and buying puts. Now let's look at Apple, because Apple is the most important name in the stock market, and let's look at the options grid for tomorrow's expiration and see where the gravity is. This is the grid for calls, and as you can see, the open interest for calls is absolutely pathetic. The dealer has no incentive at all to buy Apple shares tomorrow, and even though over 135,000 contracts of the 145 calls traded today in an effort to produce a gamma squeeze to keep the stock at 145. That failed, and the reason is, when we look at puts, the open interest for puts out of the money outweighed the open interest for calls out of the money, and therefore the gravity is to the downside. The risk is for a short gamma, not a long gamma, and the numbers we're looking at 141, 140, 139, these are the numbers with the highest open interest, so 139 should be a floor in tomorrow's trading. But if we see the volume rising higher for the 138, for the 135, if we see traders rolling down, taking profits from the 140 puts, for example, and rolling to the 135 right away, we could see a big flush down as a result of the short gamma. So for now, heading into tomorrow's session, who has the advantage, at least from a mechanical perspective, looking at one indicator alone, that is Apple, but perhaps the most important one? The answer is bears. Bears have the advantage here. But can the core PCE change the dynamics? We'll see. Here are the unusual activities that took place in the options market today. We start with the ticker LQD, and this is the ETF for corporate grade bonds. Now do yourself a favor and pull up the chart of the LQD. The chart made a lower low. It is now trading below the 2020 bottom. I think this is an important message, as if the LQD is sounding the alarm. Something is wrong here. Something will get out of hand. There is a crash underway in corporate bonds. And the question is, how long can it go before something blows up? Anyhow, somebody sees more downside for the LQD, and they bought the 96 puts for the expiration date, October 7th, with expectations that the name could move down and lose more than 6.5% of its value by then. They paid around 16 cents a piece to enter this trade, all in all spending around $350,000. And then what about the ticker ARKW? This is one of those Mama Kathy Tesla Witch ETFs, the next generation ETF, internet, whatever that is. Well, somebody sees a bounce coming for the name, and they bought the 50 calls for the expiration date, October 21st, with expectations that the name could move higher and gain more than 9% by then. They paid around $1.35 a piece to enter this trade, all in all spending around $2 million. And then what about Apple? AAPL. Folks, the traders continue to pile in here, buying more puts aggressively so. And in this case, somebody bought the 134 puts, for the expiration date of October 7th, with expectations that Apple could lose more than 6% of its value by then. They paid around $1.15 a piece to enter this trade, all in all spending around $1.6 million. And then what about the ticker BX for Blackstone? I'm short the name. I've been short for a while now, and we see the name crashing. It's going to to crash even more. Are we going to feel good about it? Because when evil corporations crash, why not? And somebody sees more declines here for Blackstone. They bought the $70 puts for the expiration date, November 18th, with expectations that the name could move down and lose more than 17% of its value by then. They paid around $2.20 a piece to enter this trade, all in all spending around $2.5 million. And here it is, GME, GameStop, the apes, or whatever they call themselves, I don't know, who cares? Somebody sees the name moving down from this point on, and they bought the 23.75 puts for the expiration date, November 18th, with expectations that GME could move down and lose more than 7% of its value by then. They paid around $3.20 a piece to enter this trade, all in all spending around $3.5 million. Watch out for the bets against the XLU too. You see, utilities, the ETF for utilities is the XLU, has been an outperformer, but as of late, I've been seeing more and more bets against the XLU, and usually that happens right before the big crash. I saw the same phenomenon back in 2008, and we're seeing it once again. And I just noticed that I skipped the name at the top of the list, the ticker STWD. This is for Starwood Properties. The company owns a bunch of hotels and I believe a bunch of golf courses or whatever. It is a dividend-paying name, but we have witnessed unusually large options volume this Monday. Somebody knew what's going on here. And they bought a lot of puts, and what do you know? Today the name is down over 9%, and somebody sees more pain to come. They bought the $16 puts for the expiration date, December 16th, with expectations that the name could move down and lose more than 13% of its value by then. They paid around 60 cents a piece to enter this trade, all in all spending around $1.3 million. Continuing with interesting trades, what about the ticker COST, Costco? Somebody's making a major bet here. They bought the 445 puts for the expiration date, November 18th, with expectations that Costco could move down and lose more than 7% of its value by then. And they paid around $11 a piece to enter this trade, all in all spending around $5.5 million. And then we have the IWM, the Russell 2000. Somebody sees more downside here. They bought the 157 puts for the expiration date, October 31st, with expectations that the name could move down and lose more than 5.5% of its value by then. They paid around $3.35 a piece to enter this trade, all in all spending around $1.6 million. And then what about the ticker TSLA, the souffle? Somebody sees more downside coming here, although Tesla has its AI day, whatever that is. More pumping from Reverend Elon, perhaps more empty promises, we'll see. But somebody sees more downside here, and they bought the 235 puts for the expiration date, October 21st, with expectations that Tesla could move down and lose more than 12.5% of its value by then. They paid around $7.25 a piece to enter this trade, all in all spending around $3 million. And here's another big one for DE, the ticker Deer. The ticker is DE. The name is Deer. It has been an outperformer, but perhaps the party's over because somebody bought the 310 puts for the expiration date, December 16th, with expectations that the name could move down and lose more than 9% of its value by then, and they paid around $13.60 a piece to enter this trade, all in all spending around $5.5 million. Now let's look at charts for some of these trades, starting with COST, Costco. We talked about the chart before. We have a massive head and shoulder formation on the weekly chart, and the trader has the 445 puts. He sees the name moving at a minimum by about 4.5% from this point on, but in reality, the trader is betting that once the chart reaches 445 and it breaks that support, we will see a short gamma that takes us all the way down at around the 390 level, and that would be a decline from this point on of about 16.5%. And then here's the trade for DE, Deer. The trader sees the Fibonacci support being broken. We're talking about 327.5. If that is broken, the name goes down all the way to the next support at around 285. So ideally, the trader sees Deer way below 300 by the expiration date. Moving on to the heat map analysis, what do we see here? A sea of red, a massacre with few exceptions. Exception number one is Visa in financials, barely in the green. And then we have some big pharma names that performed a lot better. But the most notable outperformer, energy, along with certain materials such as gold and copper. And I tweeted this in the morning. I said, despite a big down day for the market, the dollar is down and it looks as if it is cooling. If I'm buying any dip here, as a short-term trade, it will be in commodities-related stocks. And I did buy the dip using calls in Occidental, the ticker OXY, and Devon Energy, DVN. And both names managed to outperform today. But keep in mind, the market is really jittery. And if we have a nasty surprise from the PCE tomorrow, we could even see names such as Devon and Occidental moving down. So the lesson of the day is always be closing. If you're going to play these rebounds, make your buck quick and fast and get out, because we don't have anything right now that says we're out of the woods, even in energy and commodities related stocks. For all you know, the dollar pops higher tomorrow for whatever reason. Now let's talk about some corporate news here, and we start with SoftBank, aka the devil. And remember when SoftBank was rigging the options market by false gamma squeezes, buying options ahead of time, making all of these billions of dollars, but nothing really in the fundamentals. All of these vision funds are nothing more than gambling schemes. Some would argue Ponzi schemes. And now the tide has turned for SoftBank. Their stock is down big. Their investments blew right in their faces. Their gambling did not pay off. So who will be punished here? Not the CEO, of course. It's going to be employees. SoftBank is now slashing 30% of the staff in its vision fund. Apparently, the vision fund went blind. And then we have news from Meta, aka Facebook. And Zucchiniberg, of course, is another lunatic who is obsessed with the metaverse. And this is costing the company. The stock of Meta is trash right now. And of course, at some point, the crash in the stock will be reflected in the company's fundamentals. And Zucchini will not be able to keep his army of employees. That's not going to happen, overpaying all of these employees. So now he's putting some of them in a 30-day list that is giving them 1 month to find a new role in the company or leave. Here we go with the tsunami of layoffs. And lastly, what about Google? I don't know if you got one of these, but if you have Stadia, well, that's gone now. It's a failure. So next year, January 18th, 2023, they're done. They're gone. Off. What does that mean? They're going to lay off all of these employees and engineers from this platform. Moving on to the heat map for the ETFs, a sea of red, losses across the board with few exceptions. Most of these exceptions are in commodities, but bear in mind they did not outperform by a lot. Most of them were not in the green. They were flattish or barely in the green. We're talking about oil ETFs such as the OIH, the XLE, pretty much flattish for the day. Gold ETFs, the GLD, flattish for the day. Flat is good in a day like today. But besides that, it is a massacre across the board. And the growthy kind of ETFs, be it in tech, be it in healthcare, led the declines today. Now let's move on to charts, and we start with the SPY, the S&P 500 30 minutes chart. What do we see here? We're still at the June bottom. Today the chart cracked below the June bottom for the first time, and we're talking about 362.16. But by the end of the day, we saw the rescue operation, and the SPY closed above 362.16. Okay, you want to play this game? Let's play the game. If the core PCE doesn't come out supportive tomorrow, we lose the June bottom. But if it does, and the SPY recovers, we have the resistance of 368, number one, and number two would be closing the gap. And here's the daily chart for the continuous contract for the S&P 500. Again, we got below the June bottom, but the chart is still holding. And I would say that the June bottom will not be lost once and for all until we see a crossing and a closing below 3,600 in the futures. And therefore, I'm using 3,600 as my support line. Now, the volume is negative. It is above average on a down day, but the momentum indicators are improving a little bit. Look at the RSI, for example. Is it curling its way higher? Is this a reliable point for a bounce? Is the RSI weak enough to produce a pop? The answer is, it is. But at the same time, it could go a lot lower. It could get even more oversold. And you're not out of the woods until you get the confirmation. What is the confirmation? The confirmation is a crossing in the MACD indicator producing green impressions on the histogram. And you should be even more conservative by adding a confirmation, not just one tick, one green tick on the histogram, and you say, okay, we're out of the woods. We need to see more. We need to see the chart trading above 3,855. Then we're out of the woods. But for now, it all depends on the core CPI tomorrow. If it comes out hotter than expectations, down we go, and we crack below 3,600 and the June bottom goes. But if the core CPI comes out supportive, we could see the beginning of the journey in the attempt of recapturing 3,855 as support. The Qs, 30 minutes chart, what's going on here? Unlike the SPY, which has been on the June bottom for a while, the Qs until today did not retest the June bottom. But here it is. Now we got the retest, and the first retest was successful because it produced a bounce by the end of the day. But again, you can't make anything out of it here. You can't say that this is a buy signal until you have the fundamental factor out of the way, and this fundamental factor is the PCE, and after that, earnings. So I don't see how market participants can have the confidence and the conviction to buy right now, knowing that we have not just the PCE tomorrow, but we have corporate earnings, and we could see an earnings recession. So the bias for now remains to the downside. The bias for now remains that the Qs should be cracking below 269.29 and the June bottom will be lost. Here's the daily chart for the continuous contract for the Qs. We got the retest, we got a rebound for now. The momentum indicators, the RSI in specific, are improving, but the volume remains above average on down days. We need to see the volume cooling off before we say, okay, this is a good point for another rebound higher. Absent of that, the June bottom will be gone. What about the IWM, the Russell 2000, 30 minutes chart? What's going on here? The IWM has been retesting its own June bottom over and over and over and over again. Let's say at around 164. Now, one way you could look at this action by saying, hey, look, it is holding. It has been retested over and over and over and over again, and it is holding. And that is bullish. But there is another side to this, which is if it is solid support, if it is secure support, why didn't the IWM rally higher? Why did it fail to rally? Why did it go down to the same support to recheck? That tells us that there is weakness here. There is a lack of demand by buyers at these June bottoms. Can the core PCE fix that and increase the demand by buyers? That is certainly a possibility. But for now, the way I see the psychology playing is the following. The chart went down to the June bottom, asking for buyers over and over and over again. The buyers did show up, and they got the chart above 170, but that rally frizzled out. And here we are again, retesting the same support. You got to be a sucker to jump in and say, okay, I'm a buyer here, when you just saw and witnessed the last batch of sheep getting slaughtered. So you need something to support you in your decision to buy the dip right now, and that could be the core PCE. We'll see. What about the Dixie, the dollar index? What's going on here? We're waiting and waiting for the retest of 111.2. If we see a rebound, we could see an ABC pattern for the dollar. If the dollar continues to move higher, this is bad news for equities, bad news for commodities. On the other hand, if 111.2 does not hold, and we see the dollar going down all the way to the trend line in yellow, that would be positive news for equities, that at least we have a tradable top. And if that is the case, then we will see gold moving higher. For now, gold is waiting for the dollar to go down. And the confirmation would be gold cracking above 1,671 and closing the day above that number. But better yet, for me at least, I like to be more conservative here and use 1,685. I'd like to see a closing above this number before I say, okay, I can see at least a rally here, even if it is in the short run. And here's the daily chart for oil, Brent. The support of 85 remains intact. The bulls have yet to crack above the sloping line of resistance, which is proven over and over and over again to be really, really tough. At what point do the bulls capitulate and say, okay, no more? We can't make it. We tried once and twice and the third time, fourth time. It's not working. It's not happening. If that happens, down we go. 85 is lost for support. If 85 is lost to support, you will see a flush down kind of sell-off in oil. Likewise, if the bulls succeed in cracking above the sloping line of resistance, it's going to be by a massive pop. So we know there is a major move coming here in the oil market. Buckle up. Here's the 10-year yield, the daily chart. After the massive down day, we got a little bit of a rebound. Market bulls are now arguing that this could be a formation of either an ABC pattern, reverse ABC pattern, meaning we go down to 3.5, or with similar results, meaning going down to 3.5. Is this the beginning of a bear flag formation? I say too early to say here. Let's not speculate. For now, what we know is there is a reversal, and the reversal is done. It reversed at least 2 days worth of activities in the 10-year. But now what? Can it erase the bullish momentum? That's not going to happen without the 10-year closing below 3.5. Otherwise, for all you know, this is just a dip, a move down to gather some energy, and then we see the 10-year blasting higher. And the same goes for the 2-year. They look identical right now, so I'm not going to say anything more than this. TLT, weekly chart, what's going on here? Still below 109. We still have a negative impression in the MACD indicator, and we still have the RSI diving down, and we still have the volume continues to move higher, indicating that the sell-off is not over in the TLT. At least not right now. What about the VIX? Perhaps the bulls could look at this. This is the 4 hours chart. The bulls can look at this as a sign for optimism. Why? For one thing, it looks like a formation of a reverse ABC pattern. It looks like a formation of a bear flag. But most importantly, the VIX could not make it above 33, even though we got a massive sell-off in the stock market. What's up with that? The bulls will look at that as a sign for optimism. What about Apple? This is not a sign for optimism because Apple lost 145 as support, so now the chart is way below 150. That's gone. The volume is moving higher significantly, as we see the stock moving down. The momentum indicators are getting weaker. It appears there is another massive move coming to the downside. Looking at the RSI, looking at the MACD, there was another flush down before they get oversold, quote unquote. Tesla, an hourly chart, what's going on here? We talked about the bear flag pattern. We talked about the recent rally in Tesla, if you want to call it that, as a process to work out the oversold conditions on the RSI. Once that's done, once the chart failed to crack above the gap of 288.49, it formed a double top, and after that you get the flush down right away, all the way down to 267, which is a triple bottom for now. Is it going to hold? Is it not going to hold? In the short run, we could see a bounce. That's not out of the ordinary because the chart is getting a little oversold. But the bottom line here, you watch 267, because if the chart rebounds from that number and then it reverses course and it moves down in a revisit, that is a sign that the chart is going to crack below this number, and we will see a flush down, because once that happens, the mechanics start to play out, the reverse gamma, etc., etc. So if you see a move higher than a slice below 267, this is a sign that you might want to jump in and trade some puts. And here's the daily chart. Let's say that 267 is gone as support. After that, we have a gap on the daily chart. And lastly, tulips, Bitcoin, what's going on here? A 4 hours chart. It appears that the reverse ABC pattern is not as strong as we anticipated yesterday, because we have consolidation now and an attempt to move higher. The bears will look at this as, okay, if it is not reverse ABC, it is a bear flag pattern. Sooner or later, the chart will go down. But the bulls will look at this as, wait a minute here. What if this is an actual ABC pattern, an actual bull flag? And the next move will be revisiting 20,000 as resistance, and the chart might be successful in cracking above 20,000. Now, apologies. I know a lot of you like the meter, the bull versus bear, and which charts are in the bearish camp or the bullish camp. I forgot to do that tonight. But let's recap here. Which charts give the bulls the best hope? Bitcoin is one from a 4 hours perspective. The VIX is one, also from a 4 hours perspective. And then maybe the dollar and the 10-year if they continue to go down, if they crack below the levels that I talked about. But the rest of the charts remain in the bears camp. And lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have a busy day, starting with the PCE, core PCE inflation most importantly, and then we have real consumer spending, real disposable income, the Chicago PMI, the University of Michigan Consumer Sentiment Index, on top of a lot of Fed zombies speaking, including Vice Chair Braindead and New York Fed President Williams. Remember what the insider said? He said listen to 3 people only: Jerome Powell, Braindead, and Williams. A lot to look forward to in tomorrow's session. A lot of activities about to happen, so I'm not going to keep you here for too long. This is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again over the weekend.
What'd you do today? For our family.
Bought a strip club.